Hello, I'm Sam Pearl, and this is The Art of Dealmaking. Joining me today is Rob Brown, Managing Director and Co-President of Lincoln International. Rob heads the firm's Business Services Group, where he maintains key client relationships, leads deal teams, and helps to market the firm's services. Rob also sits on the Management Committee. Thanks for joining us today, Rob.
Thanks for having me.
I was hoping you could start us off with a little bit of your professional history and how you started working with Lincoln.
Sure. I'm actually one of the first people at Lincoln. So I started my career coming out of undergrad from the University of Illinois with an accounting degree, and like every other accounting degree, from there I ended up going into public accounting. I quickly realized while it was a great background, it wasn't what I wanted to do long term. I was fortunate enough to have the firm move me to New York into their M&A group. First doing financial due diligence for private equity group buyers of businesses, which was my first exposure to the M&A world. And then subsequent to that, after going back to business school at Columbia in New York, I came out into the firm's wholly owned investment bank, Pricewaterhouse Securities at the time. Moved back to Chicago to help start the office here of Pricewaterhouse Securities, and happened to meet some other people that were looking to form a Chicago-based middle market advisory firm called Lincoln Partners, and decided to join them. And so was one of 6 people to start that, whereas today we're over 400 people globally with 16 offices in 14 countries.
How would you characterize the current state of the M&A markets that you engage in globally?
So the markets we participate in is middle market M&A, and we define that as 50 million to 500 million US dollar enterprise value of businesses. So in that market today is very strong. We are seeing valuations of businesses and deal activity and lending activity into that market really as strong as it has been since the last peak, and in some ways even stronger than '07.
Can you describe some of the current trends that you see in cross-border investing?
Sure. So, I think one of the reasons we built the firm the way we built it, which is we have roughly half our people in the U.S., half our people outside of the U.S. We do about 60% of our deals in North America, the other 40% in Europe, Asia, and South America. One of the reasons we built the firm this way is we started realizing really 10 years ago or so that almost every industry in some way, shape, or form is under pressure to be global. And if somebody was going to sell their business in the U.S. or anywhere, the ability to give them the comfort that you could identify, access, and penetrate the right buyers around the globe was going to be key. And in some regards, we saw this in the bulge bracket firms in the 80s, in the 70s and 80s. I think at one point in the 70s, Goldman Sachs had no offices outside of the U.S., right? And so what they went through in the 80s and 90s to serve their clients on a global basis, we really wanted to replicate in the middle market. And I think it's paid off because almost every industry in some way, shape, or form is under pressure to be global. And so in the M&A world, then, if your industry is under pressure to be global, you either need to become global yourself or you need to be part of somebody that can serve your market on a global basis. So I think, just in general, we're seeing more global consolidation of industries. Interestingly, one trend we've seen in the last 2 years, really 3 years, is foreign companies wanting to invest into the U.S., particularly European countries, because while we may have complained or we may feel frustrated by our anemic 2% year-over-year economic growth coming out of the downturn, Europe would have killed for that kind of growth. Europe's had a double-dip recession, and the UK maybe even a triple-dip recession. So you're finding a lot of global strategic companies in Europe looking at the U.S. market and saying, if we go through another downturn, that's a market I want more exposure to. And so we are seeing more inbound interest in the U.S. And I think your Asian companies, particularly your Chinese, who have said, we're very comfortable being the light assembler and manufacturer for the rest of the world, but we'd like to control the channels, we'd like to control the brands, we'd like to do a bit what the Japanese did in the 80s in terms of flexing their economic muscle in the largest economy in the world, which is the U.S. So we are seeing a lot of inbound. We are seeing outbound as well, but I think a trend coming out of the downturn has been, the U.S. is still an economy where people want to have more assets put to work as opposed to less.
Switching gears a little bit, you mentioned that there's a lot of interest for European investors in the American market. What are some of the European markets that American investors should be looking at?
I think it depends on the industry. So I think if you look at the manufacturing economy, you're going to see a lot of German inbound. because Germany is really still the best engineered product or manufacturing economy in Europe. I think if you look at service-based companies, it's really more of the French and the British who are looking to expand into the U.S. And I think their economies as a whole have evolved more into, logistics and HR services and marketing services type companies.
When you're doing all these deals around the world, what are some of the differences in the due diligence process that are really important in getting the deal closed?
Yeah, it's a great question, Sam, and I think one of the things we've seen, and I think where we sit, we're in a unique position to see this, is we're seeing the U.S. market evolve a bit more towards the European market. And what I mean by that is, in Europe, and particularly in a place like the U.K., which is still the most active capital market in Europe, when you're selling a company or when someone's buying a company, a lot of the diligence is prepared by the seller. They'll have an accountant's quality of earnings report put together. They'll commission somebody to do a market study, some strategy consultants do a study of their market. They may have the environmental reports done, the insurance reports, whatever it is, and there's a whole stack of seller-prepared due diligence materials that then go out to the interested parties at some point. And then the interested parties come back and they say, to what degree are they going to rely on that, and to what degree do they need to supplement that with some additional work? Traditionally in the U.S., each interested party would have done their own work on those fronts, and they wouldn't have necessarily trusted the buyer or the seller to prepare those for them. That's changed, and I think a few reasons for the change is there's been some precedent legal rulings where the accountants are now much more comfortable sharing that information with the investors, provided they sign a release or they get indemnity from the seller. And I just think the efficiency of the markets have realized, well, as opposed to 6 of us doing this, we can have one do it, we can rely on it. We may hire some of these same firms for ourselves, so they're going to do down the middle reports, they're going to be honest with us. And so I think what it's done is it's streamlined processes here. And I think it's also another lever for sellers to use to say, well, why do you need 60 days exclusivity to get this deal done? I'm already delivering all this diligence material to you. So I think it's also compressed the back end and it's taken some risk out. So one key difference is in certain areas in Europe, like in the UK, the ultimate buyer of the business then gets what's called due care, where they can actually sue those providers if they find something wrong after they own it. We're not quite there in the US. The legal precedent hasn't gotten there, but I could see it heading that way.
Which of these European nations would you say has some of the most interested investors for the American market?
Well, I think a lot of the American investors are trying to figure out Asia. And they're trying to say, and not only, if you look at a lot of companies that went to China 10, 15 years ago, they moved their manufacturing there. They may have moved some operations there, whatever were high labor content elements of their business to serve the US and European market. As the Asian market matures, you're now finding companies wanting to be in that market to serve that market. So I think if you're sitting in the US, I think the US companies, where they view many of them as their higher growth markets, are in Asia, because they're just higher growth economies, and whether it's China or India. And I think the new regime in India, which seems very pro-business friendly, is going to create a lot of inbound interest in India, and we're seeing that. With that said, the largest cross-border, the largest number of cross-border deals in the world is between the US and Europe, both ways, because you've got the two most evolved economies. And so where you see consolidation among players is between Europe and the US. Where you see foreign companies wanting to invest for growth, it's into Asia, and to a lesser degree, although I think it'll continue to grow, into South America.
To finish up, I'd like you to give me 2 headwinds and 2 tailwinds that you see as being prominent in the current global M&A landscape.
Sure. I'll start with the tailwinds, because I'm an optimist. I think there are 2 major factors today that are driving deal activity and are driving valuations high. One is the credit markets. The ability for buyers of businesses, private equity groups, and strategic buyers to borrow money to fund purchase prices is as strong as we've seen it. The multiples are every bit as high as 07, and in some ways better. I mean, you're seeing covenant-like deals, you're seeing unitranche structures with very little amortization. So I think that is a tailwind, because what it does, it allows buyers, if a private equity group can get 5 to 6 times EBITDA leverage on their business, and they're going to contribute 30 to 40% equity, well, you're already at an 8 to 9 times, maybe even a 10 times valuation for a business. which then pushes the strategics to have to pay at least that to get a deal done. So I think the liquidity of the credit markets is a real tailwind right now. I think the other tailwind, and also capital market driven, although a little bit different, is the strength of the equity markets over the last 2 years. So you have a lot of large strategic companies that their stock prices are up 35, 40%, sometimes even a little more, and they're trading at record high multiples. That has two implications for them. One, psychologically, we find that strategic buyers, when they feel good about themselves, they tend to go out and want to buy other businesses. So when their stock prices are up, just psychologically, they're feeling good about their own business, so then they feel good about going and buying other businesses. Secondly, and I think more practically, a lot of these large strategic companies have organic growth rates in the mid to low single digits, yet they're trading at levels that are expecting them to grow. So if they're not getting the growth organically, they have to go buy that growth. So there is pressure to go out and do acquisitions, and where we see it in what we're selling is, coming out of the downturn, you would only see strategic buyers look at things right in their bullseye. Businesses they were already in, and markets they knew, where they could fold things in, they viewed as low risk acquisitions. Now you're seeing strategic buyers look at things one or two derivatives away from their core businesses, because they're saying, well, we got to grow, and our core businesses are not growing at the rate we'd like. We need to get in new businesses. So that's a phenomenon we're seeing. So I would say those are two real tailwinds that it'll be difficult to see how long they last, but we don't see those falling off a cliff in the near term. I think in terms of headwinds, a little more difficult question, because it's such a good M&A market right now. There's not a lot of headwinds. I would say there are two, though. One is a macro headwind. We are not in a high growth economy, and I think there's a view that we've come out of this downturn very slowly, probably the slowest recovery since the Great Recession. And I think there's a belief that, hey, we'll get back to a higher growth economy, a 2.5%, 3%, 4% growth economy, and that'll really start fueling some actual organic growth. That's a little bit of a headwind right now, because it's just not on the horizon. I think the other headwind potentially is increasing regulations, and really in two fronts. Dodd-Frank is only about halfway implemented. As that gets fully implemented, that is going to put more restrictions on debt availability and who can lend and how much lenders can lend. And I just think, we are in a much greater regulatory-driven environment than we ever have been over the last 8 years. Now that helps businesses that are regulatory-driven businesses, but as a whole could stymie a real economic recovery here.
Rob, thanks so much for your time.
Thanks for having me.
Again, this was Rob Brown with Lincoln International, and as always, here's to the deal.